Okay, again, welcome back to the next session. Still, we are doing advanced financial management. We are doing advanced financial management. We are doing advanced financial management. That is advanced financial what? Financial management. Advanced financial management. Advanced financial management. That is our unit course. That is our unit course. Remember, this is a CPA. This is a CPA advanced level. This is a CPA advanced level. CPA advanced level. Last class we did valuation or mergers and acquisition. We did mergers and acquisition. We did mergers and what? Acquisition and acquisition. So before you do merge one or two companies or buy another company, you must do what is called valuation. Valuation is a process of determining the market value of a company. It is a process of determining the market value of a company. So we have to do a valuation. We have to do a valuation of what? Target company. Valuation of a target company. We say a target company is the company we are purchasing. So we need to identify the exact market value of that company. So what we need to do here, we are looking at the market price per share, the market price per share, MPS. So we will use the concept of discounting the cash flow, discounted cash flow. If you have done financial management, that is intermediate level, I think you have done the time value of money, where you are asked to do discounting of the cash flow. So here, I will have a few illustrations. Say consider the following cash flows. Consider the following cash flow. Consider the following cash flow. We have year one. We have years 1, 2, 3. We have the cash flow 10, 18, and another one is 21. That is the cash flow. You're being called the cost of capital. Cost of capital is 10%. The cost of capital is 10%. Required, determine the value of the above. Required, determine the value of above what? Target company, of above a target company, of above what? Target company. So we are being required to get the value of the target company, given this discounting cash flow, So what we have to do now is we discount this cash flow, we discount that cash flow. So before you do discounting, you must check the nature of what? The nature of cash flows. Is it regular cash flow or irregular cash flow? It is irregular cash flow. If it is irregular cash flow, then it is good. Just get our discounting factor. Just get our discounting factor and get the present value. That present value is the value of that company. So we have been given here 1, 2, 3. We have been given the cash flow 10, 18, 21. You need to get the discounting cash flow PFIF, 10%. PFIF 10%. I will be reading this directly from back of my past papers. Because I have table 1 and table 2. So we are using table 1. That is the for lump sum model. So you will go to the 10% and read your values downward. So 10% year 1, I'm getting 0.991. Year 2 on 10% is 0.8264. Year 3 is 0.75. 3. Then you multiply, you get the future value. Just cross multiply. So you multiply, so here I will have 10 times 0.91. Here I will have 18 times 0.8264. Here I will have 21 times 0.7513. Once you get that one, you add this one plus this one plus this one to give you the present value. And that one is the market value, of that target company. That's how we will be applying this concept. That's how we will be applying this concept in this topic. So let's look at the past paper. We go straight away to past paper. May 2016. So open the past paper, May 2016. Open the past paper. So we have the quiz, May 2016, question what? Question 4B, May 2016, question 4B. So if you have the past paper, you open May 2016, question 4B. Here is the question 4B. We have been told, which limited intend to take over a Tini Limited, another company in the same industry, full stop. Tini Limited is expected to post earning of shilling 86 million next year. Number 2, or the second paragraph, if Huge Limited acquire Tini Limited, the expected result of Tini Limited for the next 3 years will be as follows. So they have given us the sales for year 1, 2, 3, cash cost or expenses, capital allowance, interest charge, cash to replace an asset, and finance growth. Another paragraph, from year 4 onwards, it is expected that the annual cash flow from Tini Limited will increase by 4% each into a perpetuity. So underline the word perpetuity. The tax is payable at the rate of 30%, and this is a tax is paid in the same year. The profit which result are earned. Another paragraph. If Huge Limited acquires Tini Limited, it estimated that the gearing after the acquisition will be 35%, measured as the value of debt as a proportion of the total equity and debt. Will stop. After the acquisition of Tini Limited, Huge Limited could have a cost of debt of 7.4% before tax and beta of 1.6 and beta factor of 1.6. Risk-free rate is 6% and the return on the market portfolio is 11%. Required, number 1, or Roman 1, the overprice of Tini Limited, if Huge Limited were to value Tini Limited on forward pricing in target PE multiple of 8% times. Number 2, weighted average cost of capital, WACC, for Huge Limited after acquisition of Tini Limited. Number 3, the overprice for Tini Limited using discounted cash flow model, that is DCF-based valuation. DCL-based valuation, the model we are using. So let's do the Roman 1. So here is advanced financial management. It is advanced financial management. So you must have the concept of discounting from time value of money. So they need the overprice, and they have told us we use discounted model. So if it is discounted model, you have seen the first simple illustration, you need to have the cost of capital. So the first step is get the cost of what? Of capital. Get the cost of capital. Get the cost of capital. How do you get this cost of capital? Here we are using something called CAPEM. We are using something called CAPEM. If you have had CAPEM, how do we get CAPEM? It is the risk-free rate plus the return on the market minus this risk rate. We do what? We multiply by beta factor. We multiply by beta factor. Now, if you check the question, we have been given RF, the risk-free rate is 6%, 6%. Then the return on the market, the return on the market is how much, my good guys? The return on the market portfolio is 11%, and beta factor is what? The beta factor is 1.6, So we can comfortably get the CAPEM, so which will be 6 plus into bracket 11 minus 6 times 1.6 times 1.6. So how much is your beta factor? How much is your beta factor? Here now I have to have the calculator. So I will take 6. So when you 6 minus 11 minus that 5, so I will take 5. 5 times 1.6 plus 6, giving me 14%. So the cost of capital here is 14%. The cost of capital there is 14%. That is the first step. We have known the cost of capital. The cost of capital is 14%. The cost of capital is 14%. That is the first step. The second step now, they need the overprice. They need the overprice of the company. They need the overprice. If they're using earning of multiple, if they're using the earning multiple, So now we have gotten the CAPEM, and then, so what is an overprice? How do we get this overprice? How do we get the overprice? So if you look at what we have done before, we said the overprice is, you get the overprice by taking the PE ratio. We said the overprice. How do you do overprice? Say overprice, you take the PE ratio, or what? Of a predator, and remember our predator is the acquiring company. We multiply by the EPS. Of what? Of target company. The EPS of target company. So have they given us those thinker? If you can check. You can check. If you can check. Where is the overprice? Where is the market price? So we have the market price per share, which is 11. And we have the market price, which is 11. The market price, which is 11. And then we have the earning per share. The earning per share. So they have given us the PE ratio is multiple 8 times. So they have given us the PE ratio. Yeah, it is 8 times. It is 8 times. So if the PE ratio is 8 times, if the PE ratio is 8 times, what is the earning per share of the target company? What is the earning per share of the target company? What is the earning per share of the target company? What is the earning per share of the target company? So which intend to take over at Tini Limited? Which intend to take over at Tini Limited? So we have been told the Tini Limited is expected to post earning of what? So we have post earning of what? 86 million. So let's get where we can get the anything which will help us to get the EPS of that target company. That target company. See, they thought where is that? Explain that gearing of this one to that one. So if it is forward, we have the post earning. The post earning is 86 million. 86 million. Can we get the? They have not given us the. They have not given us the number of shares. So just multiply. So you can take this over price. So we will not take the overprice as the earning per share. So we'll take the total overprice of this one. So we just multiply by the total earning of what? 86, by the total earning of 86, because they have not given us the number of shares. If they are giving us the number of shares, we could have divided to get the number of shares, then we get overprice per share, and then we multiply by the total number of shares, which at the same point, we will arrive at the same value. That was the Roman 1. Roman 2 is asking for weighted average cost of capital. Weighted average cost of capital. How do you get the weighted average cost of capital? How do you get? We get by taking the weight of equity times the cost of equity plus the weight of debt times the cost of debt. And cost of debt, this one you adjust with tax. That one you adjust with tax. You adjust with tax. You have to adjust with tax. You have to adjust with tax. You have to adjust with tax. So now, how do we get the weighted of this one and weighted of this one? We know KE, the KE is same, the KE, we have gotten the KE of the equity, that is 14%. If you remember very well, we have used CAPM to get this 14%. And do we have the cost of debt? Do we have the cost of debt? Look at the illustration or the question. The cost of debt, say, which limited could have the cost of debt of 7.4 before tax? So we have 7.4 before tax. So this one we will adjust with what? With tax. That is, we take 1 minus 30%, which will give you 0.7. That's why I have adjusted the cost of debt with that 7. So it will be 7.4 times the tax, So we have this variable and we have this variable. Now we are remaining with what? We are remaining with weighted weight. We are remaining with weight. How do you get the weight? So weight should equal to 1. So our weight should be 1. So if I take the weight of cost of equity plus the weight of cost of debt should be equal to 1. They have given us, say, it estimate if Huge Limited acquired Tini Limited, it estimated that the gearing of the acquisition will be that 5% measured as the value of debt as a proportion of total equity and debt as the total equity and debt. So this gearing, which we call it WD, will be expressed as the debt over the proportion of total equity, which will be the debt plus the equity. We will take debt plus the equity. They have given us the proportion. They have given us the proportion. So this odd proportion is what? 0.35. This odd proportion is 0.35. 0.35 should be 0.35. So that one, it take this one. So this one, it is the proportion of that one. So for us to get for this one, we just subtract from 1. So it will be, for E, it will be what? 1 minus 0.35, which will give us 0.65. 0.65. So you can get your cost of capital by taking 0.65 times the cost, which is 14, plus 7.4 times 0.7 times 0.35. You get your what? Your worker car. That worker car is the cost of debt. 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 So let's get that value. So we take 0.65 times 14. That one giving me 9. This one is 9.1. 9.1. 9.1. The other one, if you adjust 7.4 times 0.7, 0.7 times 0.35, giving me 1. This one, the total of this 1.8. Yeah, just take 1.8. So if you add the two, it will be 9.1 plus 1.8. It gives us what? 10.9. 10.9. So 10.9 is WACC. 10.9 is WACC. 10.9 is the WACC. Then we go to the Roman 2, Roman 3 part of that question. Go to Roman 3 part of that question. Roman 3 part of that question. So Roman 3 part of that question is asking the overpriced 14 limited using discounted cash flow. Using discounted cash flow. If it is using discounted cash flow, Roman 3, they need using discounted what? Cash flow. Discounted cash flow. Then we need to get, first of all, if discounted cash flow in bracket DCF, that is the free cash flow. So we need to get our free cash flow. The one they have given us here, it is not the free cash flow. So let's get the free cash flow. So let's get the free cash flow. We'll take years, 1, 2, 3. We'll have sales. They have given us sales. That is in 1,000. That is in 1,000. That is in 1,000. In 1,000. So the first sale is 200,000. 200,000. We have 280,000. 280,000. We have 320,000. 320,000. Then we need to less the profit or the expenses. So less expenses, less the total expenses. So my expenses here, I can see we have the cash cost, expense, capital allowance, and interest charge. So I can add the total. So I can add 120 plus 20 plus 10. This one is 30 plus, so it will give me 150,000. This one is 150,000. The second one, I can add 60. 160 plus 30 plus 10. That is 200,000. 200,000. That one, I can add the cash expenses is 180, capital allowance is 40, and interest charge is 10. That is 50 plus 180, giving me 230. 230. So I can get now the profit before tax. Can get the profit before tax. So the profit before tax, my good student, will be this one minus this one, getting 50,000. This one is 80,000. This one is 90,000. 90,000. That is the profit before tax. That's the profit before tax. That is the profit before tax. Then we can less the tax, which will be 30%. 30% of this. 30% of this, is it coming 15,000? Yeah, we're getting 15,000. 30% of this one, 2,400. 24,000. How much? 2,400. 24,000. Then the other one, 30% of this one is 27,000. 27,000. So get now the profit after tax. Get the profit after tax. Get the profit after tax. This one will be that 5. This one will be that what? 56. This one will be 63,000. That is the profit before tax. Then because we are using a free cash flow, you need to add back depreciation. Add back depreciation or capital allowance. They have called it capital allowance. They have called capital allowance. So the capital allowance is non-taxable. So we add it. We have 20, 30, and 40. We have 20, 30, 20,000. We have 30,000. We have 40,000. Up 40,000. So if you add this one, getting 55,000, getting 86,000, 6,000, this one getting 1.3,000. This is the free cash flow, which we call it capex. This is the free cash flow, which we call it capex. That is the free cash flow, we call it capex. Now, our question is now easy. What we need to do is now do a discounting, because they have asked for the bucket value of that target company using the discounted cash flow. We have gotten our discounted cash flow. So we can now discount that one and get the value of this company, and get the value of this company, and get the value of this company, get the value of that company. So I will generally come here and say, yes, 1, 2, 3. The cash flow is what I've gotten here, 55,000, 86,000, and 103,000. Then the cost of capital, I will be using the one I've calculated, that is the 10.9. Remember this one. So you'll be using 10.9. Can say round up to 11%. If we have 11% in our, we don't have the 11% in our table because I don't have a calculator. So let's use just 10%. Let's use 10%. So 10% year 1 is 0.91. Year 2 is 0.8264. Year 3 is 0.753. So get the present value. So you will check this one times this one times this one for you to get the present value. Once you get the present value, total this one, you total that one to give you, that is the present value. But remember, we have something down there. We have something down there. They have told us, is that question? There's something you need to get there before you get the final answer. Was it? Before you get the final answer, they have said, after just that acquisition, they say from year 4 onward, it is expected that the annual cash flow of Disney Limited will be increased by 4% each year into perpetuity. 4% each year into perpetuity. 4% each year into perpetuity. So from year 4 onwards, it will increase what? By 4% into perpetuity. It will increase by 4 years into perpetuity. Okay, so there's something we have gotten here. We have not read the whole questions. They say, cash to replace the asset and finance growth, we have 25,000, 30,000, and 35,000. So that one is what is called the working capital. So the working capital, you should adjust after this one, you will adjust that working capital. So you say less that working capital. We have 25,000. You have 30,000. How much is that? 30,000 and 35. 30,000 and 35,000. So that we can get now. So this one will be 30,000. 5 minus that one, 30,000. This one will be 56,000. And this one will be 68,000. So I will change my cash flows here. Once I've adjusted that working capital, so here it will be 30,000. Here will be 56,000. And we have 68,000. But now, remember in year 4, they have told us they will increase by 4% into perpetuity. So in year 4, we will have a perpetuity there. So when you have the perpetuity, then you need to get what is called the PO, the present value of that company. When we do discounting, that is the time value of money and working capital. You have done this one in financial management intermediate level, where we said to get the PO, you take what? DI over what? The KE minus what? Minus G. The KE minus G. That is the KE minus G. So here we will take now that PO, which is the present value. The current value is this one. So we will take that 68,000. So you will take this one to get this one. You will take that. We will have to get 68,000. We will take 68,000 into a 1 plus this one. In fact, you can say this one you use DI or DO into 1 plus G. DI or DO into 1 plus G. You have done that one, you just understand there. Plus that G is the 4% they have told us. The 4% they have told us, it will increase by 4% each year into perpetuity. So plus 0.004, plus 0.004, plus 0.004. I divide by the cost of capital 10% minus, that is this one, it will be 0.1 minus 0.04. Anything you have gotten here, you are getting here, multiply by the current discounting factor, which is 0.7513, 0.7513. Then you get your value. You get your value here. So you will add for year 1, year 2, year 3, and this one for you to get the total value. Because you have the calculator which is working very smart, very good. Get for me the total value here, and that one will be your final answer as the overprice. So we come to the end of that question and end of that topic of the mergers and acquisition using the valuation model. So let's meet on the next class. For more videos, just click the link above our channel. You will get more videos there. Thank you. We'll meet next